Hello and welcome to this week's topic. Today we're talking all about managed funds. By the end of the topic, you should be able to understand the concept of managed funds and do-it-yourself managed funds, explain the features, be able to distinguish between listed and unlisted managed funds, be able to discuss exchange-traded funds, explain how to use asset allocation to construct a portfolio, an important skill that we're also using in our case study at the moment, and describe the role of limit and stop loss orders. So what do you think a managed fund is? Have you heard about this before? Have you got a managed fund? You might have one that you're not quite aware of. We'll talk more in class about this. So what is a managed fund? Well, a managed fund is an organization that invests money on behalf of its customers in a diversified portfolio. So for example, we all might decide that we want to invest our money. So we might invest it all in a managed fund. So the managed fund has our cash. They own the shares that they're investing in, but we are given what are called units. And that's how we are purchasing those shares. Means that we've got a chance to invest in a diversified portfolio, or perhaps we would choose one with a particular theme that suits us. Now it's professionally managed. So that means we don't have to worry about buying and selling or making the choice of the shares that are in the portfolio or the assets that are in the portfolio. So it gives us a chance to have a really good diversification. So for example, we might only have a certain amount of money. Maybe we've only got $5,000. That's a lot, isn't it? Say we were lucky enough to have $5,000. Now, if I was going on to ComSec to buy that, maybe I would only buy 5 shares. Now that would cost me a $10 fee for each one I'd purchase too. So there's going to be a $50 fee there. And I'm only going to end up with 5 different types of shares. Whereas I could put that $5,000 in a diversified managed fund and I'm going to end up maybe with 20 different shares. So what are some of the advantages? Well, we just talked about diversification. I could end up with 20 different shares for my $5,000 and that reduces my risks that I have because I'm diversified in different types compared to if I'd gone and bought them myself on ComSec or whatever app you're using. I've only got 5 shares. There's professional management. So I don't have to pick the shares. I don't have to worry about purchasing and selling them. You don't need a great deal of money to invest in managed funds. You can start off with quite a modest amount. And they offer all kinds of services. So for example, automatic reinvestment or withdrawal plans. Another service they offer is you can set it up so that you automatically pay a certain amount of money into it every time you're paid. It's very convenient. You don't have to do the paperwork. What day did I buy those shares? Okay, what do I need to do now when I'm disposing of them? Keeping all the records. It's not your problem when it's a managed fund. They'll do that and they'll send you a statement. There are, of course, disadvantages. So there are fees involved and you've got to pay for that manager that you're using. So there are fees when you're setting it up. There could be fees when they're exiting, or perhaps they'll charge fees monthly or annually for the service that they're providing. The managed fund performance over a long time frame tends to only match that of the market as a whole. So even though they've got professional managers, they don't actually beat it in terms of performance. There's a lack of control. You're giving your money to this managed fund. They're the ones making all the decisions. So you don't get a say. You can choose what particular type of theme you want, or if you want growth or balance or something like that, but you can't specifically say, oh look, I really can't stand whatever it is, some type of share. Don't buy that one. You don't have that kind of control. So a managed fund is an organization with several parts to it. So we've got the fund itself, which is actually a trust. It's a unit trust and owned by unit holders. You've got a management company that runs the fund's daily operations. You'd have an investment manager who's buying and selling the shares and oversees the portfolio. And you have a trustee, which safeguards the shares and other assets of the fund. Managed funds are regulated. Advisors have to be licensed by ASIC. There are specific regulations of activities covered in the Commonwealth Managed Investments Act. It's essentially operating as a tax-exempt organisation, so all the tax impacts are passed on to the unit holders. So remember, if you're investing your money into a managed fund, they'll tell you, okay, so you've got 10 units or 100 units or whatever it is for your money. If there are any tax impacts, then it comes to you and you have to include it in your tax return. Net tangible assets, so the underlying value of a unit in a particular managed fund. This is calculated by taking the total market value of all the shares that they have and all the other assets held by the fund. So add the value of the shares, the value of the assets, add them together, deduct any liabilities, and divide it by the number of units, the fund units outstanding. So this is used to derive the price that units are bought and sold at. So they may do that daily or weekly and change the unit price. We know from our research in class the share prices can change quite dramatically. When we were experimenting in class, we saw the share price change quite a lot. So how does risk impact in our managed funds? Well, as most of the managed funds are quite diversified, business and financial risk tends to be eliminated, but they do have a large exposure to market risk. The funds almost perform like the market. And there will also be a risk that is revolving around the management practices of the fund itself. Okay, so you've got your market risk. It is acting like the market, the shares, and the management risk. We describe the funds in two different ways. We could have unlisted funds or listed funds. So the word unlisted and listed, this is talking about the stock exchange. So here we're looking at unlisted funds. So this is a type of managed fund where you buy and sell units directly from the fund. So there are no maximums no limit on the number of units the fund can issue. They can just keep on issuing them. And funds guarantee the repurchase of units from investors. This is the major type of managed funds that we have here in Australia. In America, they would describe this as open-ended funds. Other type, we'll get to that a bit later. How does an unlisted fund have earnings? So they get income, they have dividends, interest and other income that they earn from their holdings, so from their shares or their assets, and they pay this to unit holders. They also have capital gains, so if they sell their shares or other assets of capital gains, and they can distribute this to the unit holders. There could also be unrealized capital gains. Now remember, we've discussed this before. It's unrealized, it's only on paper. So they've made a capital gain, but they haven't actually got it. It's not real in their hands. It's just something that exists on paper. So listed funds have these three different sources of return: income, capital gains, and unrealized capital gains. And they also have changes in the price, discounts or premiums to that net tangible asset. Here we go, listed funds. So a little bit different. These ones are managed funds in which you're buying and selling the units in the open market. So we're talking about the share market now. So these operate with a fixed number of units that are outstanding. There are no new ones that are issued. So the fund itself doesn't play a role in the transactions. It's like buying or selling shares on the stock exchange. And America would describe this as closed-ended funds. So two types, unlisted versus listed. So listed, don't have to be worried about keeping cash on hand to make redemptions. They're just buying and selling themselves. They're less restricted, so they can be more aggressive in what they're investing in and commit to longer term investments. Listed funds can concentrate more on a set portfolio of securities. So there are differences in the pricing of units with listed funds affected by the general supply and demand conditions, as well as fluctuations in the net tangible asset values. Fees and charges, unfortunately, are what get you with managed funds. So there's an entry fee in an unlisted fund. That's the commission that you pay when you buy the units in a fund. May find some have an exit fee, and there's a management fee to pay for those managers who are looking after the fund's portfolio. Taxes are also paid at the unit holder level. So if you hold units, you're responsible for paying the taxes. Many different types of managed funds. You might be interested in one that is a balanced fund or a growth fund like we have with our super. Perhaps you're just interested in one that's just looking at equity, or you might be interested in fixed interest funds. So there are many types out there. So they offer services to their clients. So you can have automatic investments. So that's where you're sending automatically from your pay each period. You send a fixed amount off to the managed fund, and they will then buy more units for you. You can have automatic reinvestment. So if you're receiving income from dividends and capital gains, then you can, instead of getting that paid into your bank account, you can buy more units and increase the number of units you have that way. So both of those type of plans are very convenient, easy way to get compounding benefits. Going the other way, you could have regular withdrawal plans so that you can, if you're at the other end where say you're now wanting to get income back, then you could do that. You want to be paid a certain amount each month or quarter. There's conversion or transfer privilege, so that allows shareholders to move money from one fund to another within the same family. So that helps if you have changing what you want, your investment goals. Then there may be tax impacts with that. So what are we using our managed funds for? We're trying to accumulate wealth, building up our capital over the long term. It's a way of storing value, so maintaining capital in a secure and stable investment without much potential for the loss of value. Or you may be using it for speculation, trading in and out of funds as the climate changes, or aggressively trading within funds. How to choose? Things to think about. What's the return that the fund's offering you? What's the risk associated with the fund? What's the intended use of the managed fund? And what are the services offered by them? So have a look in the fund's profile to answer those questions, or look in media releases or from reports. An important element is to consider the fund's investment performance. What's happened in the past? What are the returns generated in good and bad markets? Now I saw that there was CanStar have some awards for different managed funds, so you can use that kind of thing to help you with your research.